While there have been recent developments in some of these areas, especially trade policy, uncertainty around the changes and their effects on the economic outlook is high. As we parse the incoming information, we're focused on separating the signal from the noise as the outlook evolves.
Hello everyone and welcome to the week ahead on Nomura Podcasts. It's Friday the 21st of March and I'm Dominic Bunning, Head of G10 FX Strategy. We just heard from Fed Chair Jerome Powell highlighting the uncertainty around the macro outlook right now and the need to find the signal amongst the noise. As ever in the Week Ahead podcast, we'll try to do the same with our guests this week, David Seif, our Chief Economist for Developed Markets, Andrei Szczepaniak from our European Economics team, and Euban Parasueles, our Chief Southeast Asia Economist. But before we hear their thoughts, it's worth a quick rundown of the latest events and market reactions. The Fed, the Bank of England, and the BOJ all left rates unchanged, but each central bank gave its own flavour. The Fed made some notable downward revisions to its growth forecast while raising its inflation projections. The Bank of England's vote split looked less dovish than in prior meetings, while Governor Ueda suggested that recent data supported further gradual hikes in Japan. Financial markets have been difficult to navigate, with equities bouncing from their recent lows but still seeing sizable intraday swings. In FX, the dollar's rebounded as well, but after a significant previous downswing, and investors appear to have little conviction on the next big move, while interest rates also seem to be caught between potential upside inflation risks and challenging growth dynamics. All of this comes ahead of the 2nd of April tariff announcement from the US as well, which has further potential to jolt markets even more. So all in all, it continues to be a fascinating time from both a macro and a market perspective. So without further ado, let's hear more from our guests.
In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We do not need to be in a hurry to adjust our policy stance, and we are well positioned to wait for greater clarity.
Let's start with the US, and having heard from Chair Powell a few times already on this podcast, we're going to hear now from David Seif, our Chief Economist for the Developed Markets out in New York. David, welcome.
Great to be here, Dom. Great to be back.
So look, let's start with the Fed. Rates were left unchanged as widely expected. In some respects, all, quite a boring kind of event. But there were lots of interesting developments, I think, in terms of the Fed's projections, in terms of the press conference. Can you tell us a bit more about this and how you're interpreting some of those changes?
Yeah, absolutely. So, I think Powell really emphasized that the Fed was keeping its options open. Our call has been and remains that the Fed will not cut at all in 2025. But I think that what is clear, even to those who don't agree with that admittedly out of consensus view, is that there really isn't a Fed cut on the table potentially until June, barring a very unexpected development. And Powell has the luxury of 3 more months before he really has to make a decision at this point. And I think he's going to use that time to see what develops. And so he really, it seemed, took pains to give as few signals as possible in this meeting. The Fed, as expected, lowered its growth projections, raised its inflation projections, but it did so in a sort of tepid, modest kind of way. And I think that perhaps the single most notable thing about the dot plot, which didn't change in terms of medians, was that Powell really emphasized that the dot plot came out where it was at this meeting because there's so much uncertainty. There was just no way to really make a change versus December. And one could say that that's a legit thing to say or somewhat of a cop-out, but the point really is that it was clear that the Fed was not trying to signal anything with the dot plot. It was instead simply uncertain what the situation was.
And actually, just on that front, there's been some talk in the markets about whether this almost represents something of a Powell put or something like that. Now, you guys have published that you don't think there's much of a Trump put for the economy or for the stock market. Do you think there's any sense of truth in that, or do you think we're still a long way away from them when the Fed, might start to react to financial market volatility?
I think we're still pretty far away from it in terms of the prices we need to see. Obviously, financial markets being what they are, we could get there quite quickly from a time perspective. Not our base case, but of course it could happen. I think, if you look at this, our take was that this was a very neutral meeting, but certainly the market reacted dovishly to it. And forcing myself to say, what do I think could have led the market to see this as dovish? I think perhaps the single biggest thing was that Powell did downplay the upward shift in inflation expectations from the University of Michigan survey. And I think that was a little bit of a surprise. It's almost sort of the Fed examining the data that it likes and dispensing with the data that it doesn't like. Now, at the end of the day, of course, the Fed's going to want to look at realized inflation, and it does seem unlikely that we'll continue to have such a disparity in inflation expectations between multiple surveys. So likely there's going to be a even more unambiguous uptick in inflation expectations, or there's not, and or it's going to sort of converge into UMISH sort of going back to where it was. And so, I don't think that it's a really strong signal for what the Fed may or may not do 3 months from now.
Okay, great. You mentioned inflation. I mean, I guess the big data in the week ahead is going to be the core PCE numbers. What are you guys thinking on that one?
Yeah, our forecast for core PCE is 0.346%. That is, of course, then right on the bubble between a 0.3 and a 0.4. Obviously, it would be a 0.3 if it's exact, but it's a very close call between what that unrounded number is. What was interesting last week was that although CPI and PPI numbers came in a little softer than expected, the read-through of the components that go into core PCE was actually a little bit hawkish. And so we had a number that rounded up to 0.3, and now we have a number that rounds down to 0.3 and is very, very close to being a 0.4. So all in, no huge game changer in any of the data, but it actually was slightly hawkish, the CPI, PPI, and then import price data.
Great, thanks, Dave. It's all really quite interesting in terms of how that inflation picture is evolving. Obviously, one of the big potential drivers is going to be tariffs. We are getting closer to that 2nd of April date that President Trump has touted as being the big one to watch in terms of tariff announcements. And we also saw some comments from Treasury Secretary Bessent around this. Just while we've got you on, how are you evolving your thinking around tariffs? Is there much changing in your sense, or is a lot of it still what you've been talking about for the last few months?
Our view, by and large, is unchanged. We always expected, since Trump's victory, significant tariffs. The tariffs have come into place even faster than we expected. What I do think is interesting about this April 2nd announcement is that this is the first announcement where it's heavily coordinated with Trump's cabinet and cabinet level and other senior officials. So looking at the Canada, Mexico, and even the China tariffs up to this point, if we remember that these were basically revealed in a Truth Social post in 2024 by then President-elect Trump, clearly not coordinated with his cabinet, which wasn't even completely named at that point. And the market has reacted how it's reacted to that, which has been by and large more negative than not. I think that when we look at April 2nd, clearly this is being heavily worked on by Jamieson Greer, the U.S. Trade Representative, clearly Scott Bessent, NEC and CEA chairs Hassett and Myron are also heavily involved in this. They're all in place now. And so it would not be a shock to see these released in a way that's designed to be more market friendly or less market disruptive than the tariffs up to this point. And I really want to emphasize, this doesn't mean that we don't expect significant tariffs, because indeed we do. But it's a matter of how they're delivered. Do they phase in over months? And those dimensions could lead them to have a little bit of a duller effect on the market, maybe even be less negative than market expectations, and possibly even lead to some sort of a relief type moment for markets.
Yeah, I think that's really important, really interesting, because markets obviously hate uncertainty, as the cliche goes. So actually, just getting some clarity and some certainty maybe could be enough to help things stabilize, even if the tariffs themselves are pretty punchy.
And to set expectations on this, Trump is going to remain president. Trump moves how he moves, and often is very unpredictable. And of course, that's not going to change. But on the margin, and maybe in a significant way for markets, this could be something that gives more clarity and more certainty than what markets have had up to this point on tariffs.
Yeah, it's always relative, I guess, to the baseline. So great. Thanks very much, David. Great for having you on.
My pleasure, Dom.
Next, we're to Europe, where I'm joined by Andrzej Szczepaniak from our European economics team. Thanks for coming on, Andrzej.
Thanks for having me, Dominic.
So look, the big news in Europe's been around the German fiscal stimulus recently. The reforms have now passed through the Bundestag, and as we record this, we're still waiting for it to go through the upper house. But it all seems like it should take place. It's obviously going to take a bit of time for the direct economic impacts to filter through, but there's already been a bit of a jump in sentiment in Europe. Do we expect more of the same this week?
I mean, look, exactly. So we've seen already in the Centix and the DW surveys, those rose quite sharply on the back of that sentiment boost. We do expect that to feed through into the PMIs, obviously more sharply in Germany, but spillovers into France and also the Euro area, as well as the UK, actually, and also the IFO as well. So we are expecting to see that feed into the sentiment, but at the same time, we should see that also then feed into the real economy and potentially more quickly than some of the consensus are expecting. It's just worth flagging. We are more bullish on the euro area macro outlook relative to the consensus owing to this larger fiscal bazooka.
So some interesting sentiment boosts, but probably too early, I guess, to feed into inflation at this point, which is the other thing the ECB's probably concerned about. How do we think inflation's going to print in the data points that are coming up this week?
So we have France and Spain at the end of the week, and essentially there, in terms of France, we're looking for a 20 basis point uptick to 1.1%, and for Spain, a marginal slowing, bearing in mind already that rose a bit earlier on due to gas prices last year. We were forecasting on Spain at least a 20 basis point decline for the March print at least.
And in terms of the ECB, you guys are a little bit more hawkish than the market still, right?
Exactly. So in terms of April, we are forecasting a skip. Market pricing isn't quite for a full rate cut price, but not quite. It's just slightly above 50-50 in that sense. And we think the ECB will stop in June with one final rate cut. So we are slightly more hawkish on that basis. Obviously, you do have tariffs in the near term, but we think the fiscal bazooka will more than offset any of the weakness or the hit to growth from US tariffs.
Okay, great. Thanks, Andrzej. I mean, hopping over the channel, it's also a pretty big week for the UK after the Bank of England left rates unchanged at its recent meeting. Clearly, there are still some worries there about sticky inflation from the MPC. And we also get UK inflation on Wednesday. What are you guys thinking there?
So in terms of the UK inflation data, we do think it will be sticky. So for headline, we're thinking broadly unchanged. And in terms of core inflation, a very marginal moderation. But essentially underscoring that the Bank of England should be gradual in cutting rates. Obviously, we had the March meeting where they kept on hold, and we forecast a gradual pace of rate cuts. So 25 basis points per monetary policy report meeting only to a terminal of 3.5% by February next year.
And it's not just monetary policy which is in focus in the UK. We've also got the OBR's fiscal update on the 26th of October. How do you guys think about that? What kind of headroom is the Chancellor going to have here, and what might she do to give herself a bit of breathing room?
Exactly. I think this is, if anything, going to be the most focal point of the week, actually, from that perspective. So we are forecasting a 305 billion gross gilt issuance. This is marginally below consensus. Consensus is give or take 310. Obviously, a combination of higher interest rates in terms of market rates, at least, given the rise in yields, as well as inflation having been sticky, plus the weaker growth, as well as the wider deficits. Looking at those PSNB and CGNCR numbers, essentially means that public finances are running up against those new fiscal rules. To meet them, remedial measures will be needed, and we think that'll be focused heavily on welfare cuts and also spending restraint elsewhere. But even then, the rules may have to be met with less headroom than before.
Yeah, and I think from a market perspective, it's a very sort of tricky equation for the Chancellor to get right. It's one of the reasons we've had a sort of underweight view on sterling over the last few weeks, last few months even, because we just think the fiscal maths is getting trickier, and ultimately it's probably going to weigh on sterling versus some other currencies, particularly somewhere like the euro, where you're actually seeing the fiscal capacity that's been built up starting to get used and potentially starting to feed into the economy. So certainly some interesting divergences in Europe. Thanks very much for that, Andre.
Thanks, Dominic.
We're going to finish this week with Asia, and I'm delighted to have Euben Parasueles, our Chief Southeast Asia Economist, joining us. Now, Euben, this is something of a hunter turned gamekeeper kind of approach, given you often host the podcast as well. So it's good to have you on the other side of the mic. Do you want to talk us through what's happening in Indonesia at the moment? There's quite a lot of volatility, quite a lot of happening in the markets. What's going on there, and what do you think is going to happen next?
Yes, yeah. Thanks for having me, Dom. Where to start? I guess there's so much happening in Indonesia. But I guess I'll say the big picture is that obviously they still have quite a bit of external vulnerability. They run current account deficits now. And all these headlines and tariffs and the uncertainty is obviously affecting the currency. But what's changed is really the domestic policy uncertainty has also picked up by quite a lot. So instead of providing a source of resilience, it's actually exacerbating these external risks. So this is why we're seeing a lot of volatility in the currency. And on that front, it's really the fiscal situation. We've been talking about fiscal risks rising in Indonesia for a while. And I think markets are starting to catch on to that cautious view. This week, we had Finance Minister Sri Mulyani dispelling rumors that she's resigning from the cabinet. But I don't think this necessarily leads to, the elimination of fiscal fears in markets. And the reason is President Prabowo is really pushing his populist agenda. And I think these are all unfunded measures. In other words, there's no new revenues that are accompanying these new spending items. So that would put at risk, to me, the 3% of GDP fiscal deficit ceiling per year. Speaking to clients, I just came back from the US. The feedback is that 3% is a red line for them. In other words, if there are signs that might be breached, it could lead to a lot of concerns on the bond market, lead to a lot of outflows, and again, add to the pressures on the currency. That makes life very difficult for Bank Indonesia because they're still focusing on their FX stability mandate. So yesterday they didn't cut the policy, which I think is the right move. But at the same time, growth is also slowing. So there is some pressure on them to try and help out and support in growth. But I think they're a little bit hamstrung as a result.
Thanks. That's really interesting, Euben. And actually, I guess slightly differently to that, but there's a link is, in terms of central banks where there's some growth downside risks, but where we do think they can cut would be taking us to Thailand, where we've actually just changed our forecast looking for more significant rate cuts. Do you want to talk us through what's happening there?
Yeah, we had a very significant change in our forecast on the BOT. So we now expect an additional 100 basis points of rate cuts. I think markets are only pricing at about 50. And that's on the back of our recent trip to Bangkok, where we met key policy makers. And the big change really there is the BOT seems to be now putting a lot of weight in its reaction function on the growth outlook. And they're arguing that it is facing a lot of downside risks, primarily because of the global trade tensions and the vulnerability of Thailand to potential U.S. tariffs. And then, of course, the fiscal situation has not really been effective in terms of trying to support the economy. So this is a very different sort of way of thinking from the BOT. And so we now think that they could ease potentially by 100 basis points and in a successive fashion as well. And adding to that view is we will have a new BOT governor by October. And our view is we think the selection will lead to a more pro-growth official, which can work more with the government.
Okay, great. And then in terms of the week ahead, I think the main data point is probably the Singapore CPI number, and that obviously feeds into how we think about monetary policy in Sing too. So what do we expect from CPI and what are we thinking about the MAS?
Yeah, it's a super important data point from a policy perspective. Core inflation, we think, is going to be easing further to 0.7 from 0.8. So that's further below the 1 to 2% range of the MAS. And this is the last data point before the next MAS policy announcement. And Craig Chan, our FX strategist, expects another easing, slight slope reduction, the same move that they did back in January. I'm fully on board with that view because, again, MAS, just like much of the other countries in the region, are really getting worried about the uncertainty globally. And that's already putting some downward pressure on the growth outlook. At the same time, we think that because they're so comfortable in the core inflation outlook, if growth is on a downward trajectory, they could also see that as a threat to their price stability mandate and hence prompting them to ease further.
So all in all, some slightly dovish stories really emerging. Singapore, Thailand and Indonesia also facing some challenges. So tricky times in ASEAN, but obviously lots of interesting things too. Thanks a lot for joining us, Euban.
Yeah, thanks, Tom.
That's it for now, and thank you again for joining us at Nomura Research on the week ahead. I'd also like to thank John Dalton, who edits and produces his content every week. If you've enjoyed the podcast, please like and subscribe on Apple, Spotify and SoundCloud or your usual podcast provider. We'd love to hear your feedback, so do please write a review and share the podcast with anyone you think might be interested. You can also check out nomuraconnects.com for more of our research and further updates. Thank you very much, and good luck for the week ahead.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice nor is legal, regulatory, accounting or tax advice and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomuraconnects.com.